I want to bring in Rockefeller Global's Angela Mwanza and American Century's Mike Rowe. They've joined the conversation. Angela, it's nice to see you guys. Thanks. What do you think? What do you think about this market? We are like 0.8% from a new high.
It's pretty insane, Scott. And this is a conversation we've been having since the weekend with our clients, which is we're in this weird tug of war. On the one hand, we're chasing new highs and insane. On the other hand, trade tensions, inflation, geopolitical risks, all of that stands ahead of us. And the dispersion of outcomes is so unpredictable. So for us, the rule is you've got to stay diversified and not panic and do not emotionally engage. And July is going to be really telling because we've got to be able to see what's going to happen with earnings. Because if we're seeing tariffs going from 2.5% to 12, 15%, that's going to have severe implications for Wall Street and for Main Street.
I feel like, as it relates to the tariffs and almost everything, the more the market goes up, the less that President Trump and the administration are going to want to do anything to upset it. Like, what are you going to hit a new high and then your policy is going to cause some correction or close to? What do you think about that?
Yeah, well, on the earnings point, you have to remember earnings actually should be pretty good because a lot of the companies gave guidance right after Liberation Day when they had no visibility as to what May and June were going to look like. And it seems like from a narrative perspective, tariffs are just kind of in the rearview mirror, right? Like the market is absolutely looking forward to 2026 and saying, okay, tariffs may have been a speed bump. They're probably not getting worse. You're probably going to have trade deals. You're going to have the tax bill. You're going to have a new Fed chair coming in next year, likely to be a lot more dovish, and you could see more rate cuts. So whether, they cut 1 or 2 times this year may be a moot point at some point as you look to next year.
Are you bullish then?
Looking out, you can definitely make the bullish case.
Are you making it?
Yes, yeah, I think I am, absolutely. But I want to be careful, though, because you have to look at valuations. We've come a long way really fast. The S&P is trading at 30% above its historical average, right? We're making new highs every day. So what we're telling clients is be diversified. Look to areas that have not participated in the upside. Small caps, mid caps, the equal weight S&P is not that expensive. So make sure you have your eggs in multiple baskets because we're still, like to your point, tariffs really are just starting to hit now. So things can go wrong. But again, looking out to next year, you can make a really positive case.
Most of the things that people have thought are going to go wrong and never went wrong. They never materialized. We did not have a recession after the Fed started hiking rates. We haven't had tariff-induced inflation. Now, I realize it's early and anything could happen, but we haven't had that. We haven't had the labor market falling out of bed, the unemployment rate shooting up. And earnings, by the way, were better than people expected in the first quarter, too. It's almost anything that's been thrown at this market. It's brushed it off. It's remained resilient, and it continues, as I said, to approach these new highs.
It's pretty incredible. And the idea of resilience within portfolios is we want to be able to withstand whatever comes our way. I mean, watching these all-time highs in technology is really interesting when we think about where should we invest. Valuations are so high. And we're looking at how do we play the game of the shovels to the gold rush. And we're looking towards renewables because it comes down to where we're going to get energy from. That we're sitting here in the cool temperature of the studio. Outside's 102 degrees, 38 degrees Celsius for those who want to know. I don't know if we're going to have enough energy available to keep us cool in just a couple of days. And so we're looking at renewable energy. We know that they're headwinds when it comes to regulation, when it comes to interest rates. But ultimately, what can come online quickly enough, given that we have population growth and given the AI rush and demand for the amount of energy that we're going to need to power the innovation and advancement that we're hoping for.
Why is part of your playbook to trim U.S. equities? You sure you want to do that here?
We like trimming U.S. equities because you want to buy low, sell high, right? Which is trimming. We're not saying we're exiting. We like it. We like holding mega cap tech names. But we're looking at where is there opportunity? Where is it cheaper? PE ratios in the U.S. are at 27, 28 times. In Europe, in developed markets, internationally, we're looking closer to 2021. So if we're looking at more diversification, that gives us the geographic diversification that we might want. We're still being defensive. We still like things like consumer staples. We like healthcare. We're going to need to eat, and we get sick. And so regardless what happens in the world, that bodes well for our portfolios. But it really is more of a geographic diversification than a statement on, lack of faith in the U.S. markets.
What do you make of that, Lizanne? The view that we've just gotten a little expensive. We've gotten ahead of ourselves, and we're not so sure that earnings are going to be powerful enough to either justify where we are, or let's even say that we try and have multiple expansion based on the dream of what we think earnings could potentially be.
Look, I think it was a great comment about sort of adding low and trimming high, a version of buy low and sell high. That's the rebalancing strategy. That's the key tenet of that. And that helps you stay in gear with the market and not let greed or fear get in the way. And that's the way investors should think about it. And one of the rebalancing strategies that can be thought of when you have some of these whipsaw kind of markets is one that's portfolio based instead of having it be calendar based. Take advantage of that to stay in gear with the market. So I think that's absolutely the right strategy to think about. If your ultimate goal is to have the bragging rights, if I absolutely nailed it at the top or I nailed it at the bottom, good luck with that. I guarantee that's not going to be a successful long-term strategy. So that's the way I think about it. Think about the setup and think about an opportunity to do some rebalancing so you don't have asset allocation drift. And that's the best way to stay in gear.
Do you think, Mike, that earnings, which are going to begin in a couple of weeks, are going to be good enough to keep this going?
Yeah, we'll see. We've had a pretty big run. Nasdaq's up 30% off the bottom just a few weeks ago. Again, the market looks ahead. What I would say and what we believe as a firm is look at the acceleration versus deceleration. Where is the accelerating earnings coming from? As you look into next year, probably small caps, mid caps, the S&P 493. Whereas the Magnificent Seven, incredible companies, but the earnings growth slowing. So, CapEx on AI, it's booming right now.
Slowing
but it's
from
slow.
Massively strong levels.
Absolutely, massively strong levels, and you have pretty high valuations. And also in many cases, clients have so much of their portfolio locked up in 7 stocks, right? That's a pretty big risk. And if you have the earnings growth situation broadening out, you want to have exposure to those other areas.
You still watching rates? I mean, are we still concerned about a backup in rates and the bond market deciding what's going to happen in some respects based on the tax bill and how the tariffs fall together?
If you ask me, I'm concerned about everything, but I feel like it's my job to be concerned about everything. How we shore up our portfolio, regardless of what's happening in the markets, is something that we really focus on. And I work with substantial families and family offices, and for us, it's really key to look at it from not just what could go wrong, but where are the opportunities. We really like alternative investments. We like private markets, private equity, and private credit. We like idiosyncratic risk. So, for instance, if you have a favorite baseball team, if they're losing, you're still buying tickets. You're still watching them. That's the kind of asset class that we like to invest in.
You might put a bag over your head as you're sitting in the stands with the cutout because you're embarrassed to be there. You don't want anybody to see it.
Yeah, exactly.
That's a difference.
But you're still buying those tickets.
Yeah. Lizanne, lastly to you, IPO market's woken up. Bank stocks are working really well in that kind of environment. Are we going to start hearing about animal spirits again between M&A and IPOs, and that's going to be another driver of a positive story that felt like it was on pause for the best portion of the last 6 months?
For some segments of the market, I think that there is sort of itchiness to continue with deals. But I think if you're in an industry or a company that has their business model heavily influenced by the uncertainty with regard to tariffs, I think that timeout the companies have put themselves in from a CapEx, from an investment, from an M&A perspective, that piece doesn't clear up until we're at least past that July 8th deadline. But I think that there is a lot of pent-up demand there. And I think in the AI space, that's where you've not seen much diminution in terms of the spend, not just directly on AI, but to Angela's point, the infrastructure around that, the power needs, and that's part of the reason why it's sectors like industrials and utilities that are the best performers this year, actually not the tech sector. And also, one other thing, speaking of the tech sector, that I want to mention, Scott, in the lead-in, you talked about how amazing it is that the tech sector is doing well in spite of the fact that 4 of the Magnificent 7 are underperforming. But 3 of those 4 stocks that are underperforming are not in the tech sector. They're, Alphabet is in communication services, and Amazon and Tesla are in consumer discretionary. Consumer discretionary is the worst performing sector this year. So we also have to think about what truly are we talking about when we use this generic label of tech.
Yeah, as usual, you make a good point. We'll leave it there. Thanks, Lizanne. Angela, thank you. And Mike, we'll see you soon as well.